I really wish I had better news to deliver this evening, but in all honesty, the clarity we were seeking after the Fed, it's just not there. With the markets closed on Thursday, we can probably make this a quick one tonight, but I would still encourage you to watch these setups for Friday, because as we all know, balance does not last forever. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY daily time frame chart, and I know this is a pretty funky looking view here where we're omitting the April tariff lows down there, but the point we want to highlight is really that we continue to reject this overhead supply here, and it is the bottom end of the balance range from back here prior to setting the all-time high back in February. Now, we're between a rock and a hard place because if we think about what exists beneath us, it's still very difficult for me to maintain any sort of bearish bias on the market if we're still above the top end of the 3-week balance range, which of course we've broken out of over here. So between 599.25 and 595.15, I think the market's caught between a rock and a hard place. It definitely seems more like buyers are absolutely exhausted in this upper range, and we certainly aren't getting any indications of intraday upside momentum. If we were, we really would have seen follow through from the Tuesday session after Monday's rally. If I just quickly go down to the hourly time scale here, on Monday there was a decent breakout on momentum in the upward direction, and the pullback was fairly mild. Remember that the pullback here stayed over the Friday high of last week. So in theory, the best thing that the buyers could have done headed into the midpoint of this week would have been to hold consolidation over this level, 602, Friday's high of last week, and then offer some sort of brigade bolt into a new high over the previous week's high. Obviously, that's not taking place, and once again, as the buyers look fairly exhausted in this box here, you can see post-FOMC, these upper wicks continuously reject the overhead supply level at 599.25. So if I had to offer a very short-term immediate bias, it would probably be to the downside because of the exhaustion to the buyers. However, I'm as I said on the daily chart, very hard pressed to be a big bear if we're still over the 595.15 level. So I think the best sort of approach here on these spiders, the S&P 500, is to take that day-by-day approach and say, okay, if we're kind of in here, maybe there's a scalp to the downside on Friday, maybe it's risk-reward that looks like this, but I would not overstay my welcome at the 595.15. I would treat that short as a scalp. Now, if stronger sellers are going to emerge victorious here, I would go back to, let's just go to a weekly chart. What we talked about in the Saturday update video, what feels like it was just the other day, but it's kind of hard to believe we're already coming up on one more trading day in the week. The short trade needs to be underneath the previous week's low. The weekly chart simply would need to indicate a look above and fail, and then maybe we start targeting the weekly 50 SMA. So once again, how's that achieved? Well, you would really need to break back down underneath this at 595.15. So it's fairly irritating that the Fed and the FOMC meeting didn't really give the market any semblance of reasonable enough volatility to clear and break key levels. It would have been a totally different story if the day closed up here, or if the day closed down here, then we would have something to do. But as we come into the Friday session after the Thursday holiday, I would really maintain a neutral stance in this box here. I would get a little bit more bullish if we'd clear the Tuesday and today's Wednesday highs up and over 601.15, and then start thinking about this into the future should the markets firm up a little bit, and should we see broad market internals actually support the idea that the market has new money buyers who are willing to participate. The reason I'm not sold on the short side is if we take a look, we don't want that, but we want this rather, at the market internals. If you're not familiar with this dashboard, first of all, check out the video tutorial in the top right hand corner. Let's just think about what happened today, right? During the Fed, when we actually broke down underneath that key level. If we just look at the U contract here, let me go to the clean drawing set. Remember that ultimately what we're looking for is this low right around 60.30. 60.30 right around in there. As long as we're above that level, it's not really a big short here. It's more so consolidation. I know it's annoying, but really what we want to focus on is if the broad market's sideways here, let's really put the focus on individual core list items that are in balance ranges that are well defined. And we're going to see that on NVIDIA. We're going to see that on Microsoft. There's a very well defined balance on the metaverse right now. Tesla has a really nice balance range there. But back to the point of the market internals, if the market's not breaking down aggressively underneath the level, and we're not seeing substantial volume outflows on today's session, the advanced decline line is still closing over the zero line, even post-Fed, and the cumulative build is fairly flat, I don't think we have stronger sellers. Even if you were to take a look at the Tuesday session during that afternoon breakdown, you had decent volume outflows, but it's just a counter to what we had on the Monday session. If you look at the advanced decline line, it wasn't actually in trend lower zone, and intraday the read on the index score was never substantial around -15, -20, anything of the sorts. There is definitely a little bit of a cumulative build happening here, but the fact that the sellers were able to squeeze so easily on today's Wednesday morning session, to me, would not indicate that these sellers have any sort of firm backbone, as in like, oh my gosh, we have this agenda to really move the market lower here. You're just not seeing it at the exchange level. If we quickly take a look at the market profile here, another indication that stronger sellers just really aren't getting the job done is that your value area and point of control is not meaningfully migrating lower with price. I mean, yes, on the Monday to Tuesday session, it is lower, but on today's session where you close weak towards the lows of the intraday range, notice that value is still slammed towards the upper portion of the range. The point of control is inside the previous day's value area. I would really reinforce that we have an incredibly weak high, poor high at the top end of today's session. I should be accurate in my terminology. That is a poor high, not a weak high or a mechanical high. And it's because the market lacks material excess at this high. If you were watching intraday, and one of the charts I was watching intraday was this, over here, the footprint. If we just go up to literally the high of day back here, look at this, right? This is unfinished business from the sellers, absolutely. Notice the sell side delta there on the right side of the tree. So with that, let's get back on over to the market profile. And again, the nuances here are just that the market's not progressing value lower. It's totally balanced. It's overlapping. It's sideways. Sellers had a stronger agenda. I would need to see value overlapping to down on today's session. There should have been another easy sort of takeaway, air quotes easy. I'm not going to say that trading is easy, but an easier indication to understand here is if we had stronger sellers on a breach of prior day's low, sellers should have really been fishing for a substantial new lower low. That's a clean break of the previous low, and it just didn't happen, right? So all things considered, it still seems like a very timid market. Buyers are absolutely, off the gas pedal, if you will. But sellers also aren't really stepping up here in a big way. And structurally, we don't really have the evidence that would support some sort of massive breakdown until we're underneath last Friday's low, right? So that's sort of the main watch on the S&P. Let's quickly take a look at the QQQ. We're on the weekly still, so let's just have a look. Why not? We've got ourselves the same weekly structure. So as of right now, it's an inside inverted hammer. If we take out the container bar low, then fine. Maybe there's that range rotation towards the bottom, but you sort of have to break it first. I would not preemptively jump the gun on that. If we go to the daily time scale here, and let's throw on the level set, you could start to see very similar relative to the S&P 500 that you have this overhead supply here that the market's failing to really get through. Now, it's not as obvious, I should say, compared to the previous balance from back here prior to the all-time high, but it is very obvious relative to not last Thursday, but the Thursday prior to that. The high of that bar, it was ultimately on that PPI session. Thursday? Yeah, PPI is the gap up there on Thursday. Rally and rejection back into the range. You can see this very cleanly on the hourly time scale for the QQQ. It's right here, right? This is that high that I'm referencing there. You could see that on the Monday session, just like the S&P. If we had stronger buyers, this consolidation here should have persisted over the 533. Consolidation, Brigade bolt over the high, targets the top end of the weekly expected move, no dice. So being underneath 533 means that it's a little harder to be a long. And I would honestly say inside of this range here, you just have to look left at the price action. Do you want to participate in trades where it's very clear that buyers and sellers cannot agree who is in control and you get very choppy price action? If you want to participate there, if you have a range-bound strategy, if you're someone who fades highs and fades lows, by all means, do your thing. But someone who's looking for a trending market environment, this is the last thing we want to see. So main objectives for the QQQ, show me the resolution of 533, show me the resolution of 526. For Friday, it's very possible that an open in range is really just sort of like, okay, that's it, week's over, not really looking for anything impressive. If we open close enough to the top end and we can get an opening drive that looks like this, then of course we'll trade longs. 533 break, if we can Brigade bolt above looking for 536, the top end of this move last Wednesday. And then beyond that, actually now that I'm thinking of it, this is not the PPI. PPI was last week, right? I'm getting my weeks confused just as we're sitting in balance. It's so boring. But anyhow, 533 Brigade bolts target this, and then beyond that, we have the 539. If we're in range, ping pong, be my guest, 533, 526, 25 are your guardrails. If we break and Brigade bolt under 526, 25, I am very interested in this short, and the logic behind it is that we have thin structure on what goes straight down. goes straight back up, comes straight back down. There's a thin structure retracement here. So under 526.25, I think there is a valid short setup for risk reward into that 522.50, in which case we are reevaluating at 522.50. Why? Because on the daily time scale, as we look at this from a balance range perspective, I wouldn't really want to be short in an overall uptrend, right? Headed into a known area of potential previous resistance that could act as newfound support. It'd be a great spot for a potential daily high or low, and the trend would remain in the upward direction. Let's quickly take a look at our NASDAQ market internals and see what's going on from this perspective. Once again, you have your Monday massive volume inflows, Tuesday volume outflows. You're left green on the week, with today offering volume inflows even post-Fed. If you look at the advanced decline line, same conversation here over the zero line post-Fed. And if you look at the cumulative build, it is flat into today's close. A little bit more bearish on the Tuesday session, but ask yourself the question once again, as we just look at, this is the continuous contract. Let's throw in the U. We know that the futures roll has been a little funky on Thinkorswim. I'm just going to go full screen here for a second on the NQ futures. As we broke the prior day's low into the afternoon on Fed volatility, stronger sellers should have done what? They should have gotten follow through. They should have at least tested the overnight low. They should have broke to find a close and Brigade Bolt that's down here, setting up downside for Friday. It just didn't happen. So we don't really have stronger sellers participating in the market. And once again, as I said in the intro, I really wish I had better news like, hey, the market's finally trending. We're getting out of this range and it looks great. We don't have that as of right now. There's a sustained rejection up here. The market's not holding up over the 533. But am I really getting aggressive on the short side? Not until the QQQ maybe offers this Brigade Bolt here, as we just mentioned on the hourly, right? This is kind of the trade that we would entertain just because it is that thin structure retracement through this, and this on the hourly. Let's take a quick glance over at the NQ market profile. And if you take a look over here, let's just zoom this to an appropriate sort of view. There we go. The idea would be that this is sort of a short covering rally. This is a P-shaped profile, so short squeeze on the Monday session. Regardless, value area and point of control was higher on the session. You could see it here and you could see it here. So one more time, similar takeaways as to the ES. And FYI, if you're not familiar with market profile, check out the video tutorial in the top right-hand corner. The value was not moving lower today. This is almost a 45-degree line. It's not perfect, but that would just indicate that sellers basically painted themselves into a corner. So you have lack of, certainly poor high here, lack of material excess, unfinished business, just like in the ES. At the highs of these days, unfinished business from the buyers and the sellers in terms of the auction there. So once again, not all the data points here add up to looking for this massive short to do something like this. I'd still entertain the idea, but the unfinished business, it just would indicate to me that the market would not, how should I frame this? The idea would be if we revisit these highs, I would expect a break through them. Okay, then it becomes a matter of, okay, on the break, do we then hold above and offer that next rotation to the upside, right? So 533 seems susceptible based on the way that the auction is incomplete there. Let's take a look at the Rusty Russell real quick. Let's go back to our, I suppose we could go to the weekly chart. Why not? We're going to do a full weekly breakdown, of course, as of Saturday, but let's zoom in here. Where are we relative to this neckline? You know, you could sort of say the weekly is here. You could say the weekly is kind of in here. You're right at it. You have a bar that actually broke the previous week's low, and I think that's something we should key off of in the IWM. Once again, if we had stronger sellers, break of previous bar's low should bring in lower prices, especially on a weekly higher time frame. After rejecting the weekly 50 SMA, we're just not seeing it. If we take a look at the daily time scale, let's throw the levels back on. Recall that this is the same massive inverted head and shoulders. You have the micro inverted head and shoulders in the right shoulder, and your key break level is at the 209.75. The pullback has been very sloppy around it, and it's honestly just built out what I would consider a new 4-day balance range right here. So as we said in the intro, it's not the best news. We literally closed in the midpoint of that range. If we could get a break in Brigade Bolt over 211.25, great. That's bullish for the S&P 500. If we break in Brigade Bolt underneath 208.50, it's slightly more bearish. And I would really start to lean into the idea that the higher time frames, those big inverted head and shoulders we were just talking about, are failing if we break and fail below 208.50 on the IWM. So watch that very closely here out of smalls. If we take a look at the hourly time scale, it's not going to be a shocker to just see a total neutral and sideways balance range with a close literally in the midpoint. The only thing I'll call out about this is that the Russell today did open on a little bit weaker of a position, and you can see that the rally did recover the 209.75, but then failed post FOMC. Because small caps are slightly more sensitive to the economic situation, especially monetary policy from the Fed, I would carry that forward as a major data point that the higher low consolidation could not persist cleanly over the 209.75, and it did fail into the afternoon. Slightly more bearish, right? So Again, immediate term, immediate time frame, it appears as though the exhausted buyers across the three big indices are really going to prevent upside continuation until we get some flushes to the downside to offer better entry points. Ultimately, if you just go to the S&P, right? If we were to get back down here firmly, sweep it, and then come back above, using this as a launching point for the next rally, if you will, or even in the QQQ, in the NASDAQ, if the market were to flush out all of the exhausted longs from this overhead supply, come into this range, and then Brigade bolt out of it, if we could pick up new, more enthused longs, people who are willing to commit to this trade for a little while longer, this is the place to do it after some sort of daily higher low pullback. So exhaustion seems to be the case across the broad market. I'm not preemptively shorting anything, but I'm just being very cautious of new money longs if we're just noodling around sideways in these upper ranges. If we quickly want to check in just to be congruent on the Russell internals, you can see rinse and repeat of everything we've talked about so far. Basically, you've got push-pull, a little bit more bearish here on the Monday session with the lack of follow-through. After this is going to look funky because of the contract roll, but if we just go again to the U25s, you can see here on the follow through, you didn't really have as much of a bullish internal spread on that Monday session compared to what we had in the ES and the NQ. So that's a small call out there. If we look at the Russell market profile, let's get this appropriately zoomed. Value is, I would honestly say, pretty bullish here, just in the sense that it's not moving lower with price. So sure, you have that exhaustion in theory, but value's unchanged. Stronger sellers, they're just not here. So sometimes, right, and this is a classic, not saying of the market, but it's something that you have to understand in the market. Just because something's not a long does not make it a short. And I think that's a classic example of what we're working with right now. It doesn't look great in terms of risk reward to the long side, but I'm also not seeing big evidence that we would want to go out there and short the market with both hands. That's the sort of summary view. Let's go back on over to our spiders. Let's take a look at the sector watch here as we just maybe zoom in on the chart there. What do we have in terms of weekly performance? Who's leading, who's losing, and where is the weight? Semiconductors lead the pack up about 1% here, followed by the bond market, which is up about 66 basis points on the week. Then we have the tech sector and energy. At the bottom end of the barrel, it is the healthcare sector, then utilities, and finally discretionary, down about 1.4% there. Seems to me like a pretty mixed bag. I mean, semiconductors is risk on, but healthcare is a heavyweight component of the market. Utilities are risk off, but then discretionary is a heavyweight risk on component for the market. So it's really a mixed bag and not really indicating much, as the market literally just goes sideways in this balance range up here. If anything, I would say any subtle weakness that you see in tech or the semiconductor market is probably the tipping point for a little bit stronger of that pullback we're sort of referencing from the exhausted buyers here. As we look at the semiconductors chart, though, in isolation, I mean, look at this chart and try to find something bearish about it. I'm not seeing it. This is a breakout of the balance range. It is consolidation here over the previous range highs from, way back in February. That's a pretty good looking chart. I mean, today we did undercut the low of the Tuesday session, no follow through to the downside. You just want to watch the two key levels here at 258.75, and 249. If either consolidation here persists as bullish, no need to fight the tape, or if we do pull back, that's fine. Just understand that the S&P can pull back, and when and if we test this 249 for support, we want to change our bias back to up, right? That's a great spot for a higher low on this daily time frame. If we look at the TLT, a little bit of outperformance this week. However, is the bond market really doing anything impressive? No. I think what's most surprising to me about the bond market right now is with all these like crazy, maybe I should be careful about just automatically dubbing it crazy, but Jerome Powell is pretty persistent on this idea that inflation is going to surge over the next couple of months when eventually companies, corporations, the supply chain works this through and passes prices along to consumers. So he's pretty adamant about that in the FOMC, and yet the bond market is like, we're all right here, mildly lower, but that's not a huge move in interest rates, of course. So that's interesting. There's no premium to sell. We were sort of hopeful. I was kind of hopeful if the broad market was going to break, then maybe there's going to be some premium to sell in the TLT, but that's just looking like it's not the case. If we move on over to the XLK, again, hanging out near all-time highs, not in terms of being similar all-time high-wise to the SMH, but what is bearish about this? I'm just not seeing it. I mean, you're definitely in a balance range. You're not really getting clean trending activity in the upward direction for blue skies. But I also don't see like a big reason to short this. Why would you short this? I mean, maybe a little bit of a breakdown here, but really, I would think the better opportunity is being patient for the risk reward like this after setting some sort of higher low. So 235, 75. Let's move along to the energy sector. Obviously, with what's going on with crude oil, it's higher here. I still think that crude is sending a little bit of a warning, not to get the point here is not to pretend to be a crude oil expert, but with crude remaining elevated here, even after a couple of days where, okay, now the market's basically settled in and understood everything that's going on, I think crude remaining elevated is still a warning sign from the crude market that there are still concerns about perhaps U.S. intervention and what that ultimately looks like. And again, the point here is not to be an oil expert, a geopolitics expert, but if the situation in the Middle East was going to be a nothing burger, which right now it is a nothing burger for equities, but for the crude market, then you should be back down towards the unaffected price, right? Back down here towards about 65, and you're just not seeing that as of this break in the upward direction. So it's a little bit of an interesting watch there. Energy as a whole, it may cause a little bit of inflationary pressure, but you saw Jerome Powell very clearly today state it's likely to be a one-time shock, if anything, and for the most part, it probably won't even register in terms of inflation. It's all about the tariff impact that they're measuring over the span of the 3 months of the summer, basically. Jerome Powell in the Beige Book outlined 3 months as of May, which means that we probably get information or at least a Fed assessment come August or even early September, right? We'll talk more about the Fed in just a moment. Communications, nothing to talk about, sideways in the range. But once again, posture-wise, position-wise, it's over a key level. I'd be hard-pressed to be bearish here. It just doesn't look great for new money long entries. Healthcare, on the other hand, does look a little bit more concerning, rotating away from the top end of its range towards the downside, noting that this is, what did we just conclude moments ago? If we look here, healthcare, now the 5th heaviest weight sector. It's really been taking a beating. So infotech, financials, discretionary communication, and then healthcare. They're getting the boot. We might have to reorder our ratio grid. But point being is that back in the midpoint of the range is not really helping the case for the broad market to continue in the upward direction. And I think with a lack of performance from the semiconductors and tech overall, you probably would be seeing a lower market right now on some of these pullbacks. Utilities, mild pullback still over the top of the major balance range. If this is hanging out up here, not really an issue. If it starts to outperform and is leading markets towards highs, that would be an issue. We're not seeing that either. If we look at discretionary, it looks, undoubtedly, when you're towards the bottom end of the balance range, it looks more bearish. But if this is going to persist as a range trade, let's not forget the idea that generally speaking, we want to be looking for longs at the balance range lows. Very classic, very simple technical analysis 101. Buy support, sell resistance, right? Don't try to front run the idea that, okay, this time it's different and it's got to break the gap. I'm short here. Not really. Like if it moves into the gap, then fine, we Brigade bolt it for the gap close, probably pressures the broad market to the downside. But until that actually happens, I wouldn't make any assumptions about this chart. I mean, look at this candle, right? Solid red-bodied momentum straight into the daily 200. Oh my God, we're going to crack the China gap. No dice. I mean, immediately right back to the top of the range. So classic range trading is the idea. Watch, I'm going to say that, and Friday is going to look like that. We'll see. But just set some alerts, I would say, underneath the 208.75 if you're interested in watching the actual sector. Consumer staples, nothing to talk about here inside the range. If we look at industrials, this maybe starts to indicate a bit of head and shoulders failure near the all-time high, but I mean, you still have this trend line. You still have, I would not be a big bear as long as industrials hang out in this range over the China gap from back here. As long as that's in play, I mean, consolidate, fine, do whatever. Where you're at the all-time high. How is this anything other than just like weekly bull flag consolidation? Maybe if it starts turning into distribution, there's another attempt that fails and we're back in, maybe then the China gap close is interesting, but for now, bullish until proven otherwise. Looking at materials, same concept, a little bit of a drift lower, but inside this range, we know it's one of the lighter weight sectors out there, not going to move the needle for the market. Let's go to real estate. No trend reversal here. And financials. This will be a little bit of a thorn in the side for the market. I would watch this on that Friday session. If financials continue to reject this 50-40, this is overhead supply, I would be on the lookout for a bit of a trend reversal, right? This is technically a lower high. A breach of this level at 49.75 does bring in a lower low. Does this start to look a little bit like a double top? It's possible. And then a retest of this area around 48.65 would be the forecast target. Let's take a look at the ratio grid and see what's going on from this perspective. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. We can see up here in the top left, still tech is outperforming. That is risk on. Aside from that, though, it leaves a bit to be desired. This is still needs work. This needs work. This is a non-issue. Communications being one of the top heavier weight sectors. Now let's put a check mark here. That chart actually looks okay, but we're not seeing a risk-off rotation. So once again, just because something's not bullish doesn't mean it's a short. If we look at the XLP, it's not outperforming. If we look at the XLU, it's not outperforming. If we look at the risk on-off A-B sets, let's go here first, you're still checking just about 6 of 6 boxes, maybe 5 if you consider this neutral here out of discretionary. Look at the ARK-K today. If we just go on over to the ARK-K, you can see the huge follow-through in the upward direction. I don't know about you, but this is not what a risk-off environment would look like. So let's go back on over to the ratio set. Let's go to a risk on-off B set. You can see gold is underperforming today just by a mild hair. It's really not doing anything impressive. Bitcoin I would watch closely here. If I just go full screen here for a moment, notice that we do have the red Sailor shift tool. And if we're underneath the previous week's low, I would really be looking for the pullback into that 92.5 mark. If we get there, I would start thinking about the opportunity for a daily higher low to remain constructive towards the all-time highs out of Bitcoin. When and if we get here, if we can see this flip back to green, so the pullback will probably depress this a little bit as well. When we start, and if we start to find buyers there, this flipping green through the zero line would be the next sign to say, okay, let's try to grab that as a higher low. This study, by the way, we've had it on the site for a while. It's just kind of a little slept on if you're interested in that. But anyways, what else? TLT. Subtle outperformance for the week, but once again, not in a major way. If the bond market was like screaming back up to the 50 SMA here on the ratio, more of a concern, but really nothing yet. If we take a look at the dollar and interest rates, dollar moving higher has acted bearish for the equities market right now. So if the dollar continues its ascent here, maybe up towards the test of 101, which has acted as a very key inflection point on the weekly charts, right? Look at this weekly range there. If we're testing 101, that's probably downside pressure for your S&P and NASDAQ. If we're looking at interest rates, once again, very contained, not much to talk about over here. I think it's a nothing burger. It really is a nothing burger. Like I said in the intro, I wish I had better news, but there's really not much. We just want to remain vigilant, my God, on these ranges and ultimately seek when the breaks take place. This is the TNX. I wanted to go to the inverted ZT. There we go for our 2-year. So completely sideways as we anticipate yet again. Another pause from the Fed. If I just quickly flip over to the Fed Watch tool, let me give this a refresh. Obviously, the rate cut already happened. So let's go back to this grid. And there we go. Now we have the next meeting, which is right here. So there you have it. We've, maybe in July, we'll watch out and see if these odds uptick on any sort of deterioration from the labor market. But Jerome Powell seemed very, very adamant on his stance that, nope, inflation is going to show up in the next 3 months, and we need to be prepared for that. So let's keep rates where they are and not do a thing. So nothing. I hate it. I wish I had better news, but honestly, I just don't. The only things we could say here are the uncertainty about economic outlook remains elevated. It's diminished from. So you notice they've struck out the increased further, but rather just replaced with remains elevated. Unemployment rate remains low is what they've added here, and they've eliminated the risks of higher unemployment and higher inflation have risen, and instead they're just seeing risks to both sides. So this is your strike-through version. Those are really the only updates from the statement. If you look at the SEP, which is the document that was released today, what we care about is our median projections here. The Fed basically sees a contraction in GDP. They see a small uptick in the unemployment rate, and here is that inflation coming through that Jerome Powell just kept hammering on and on and on about in the press conference today when asked, like, hey, like, why aren't you guys bringing rates down? He's like, okay, well, if you looked at the Teal book, and he made the joke, hey, you could read it in 5 years, just remember to do it. If you don't even have to read the Teal book. If you read the Beige book, it tells you in 3 months, companies are expecting to pass along prices to consumers. So that's what the Fed's trying to stay ahead of. They're trying to be forward-looking. So inflation getting an upward revision there and no change out of the Fed funds rate. The longer run remains unchanged here as well, meaning that the neutral rate from the Fed apparently is about 1%, which is just kind of funky because if you consider this between a 3 and a 3.9, you would see that obviously that's a 0.9 neutral rate there. So we'll see how that resolves. I don't know why you would want a lower neutral rate than the long run rate if you're trying to combat getting here in the first place. I mean, obviously, if you consider where inflation is as of the last print, you're at a little bit more restrictive than 1% anyways. What else is going on here that I found interesting? We talked about this briefly in the live show, but if you consider this is the dot plot. So this shows all the votes from the FOMC members. This is the median projection, right, which keeps the SEP giving us that 3.9. But notice that a majority of participants outside of the consensus view at 3.9 were actually higher, up towards a 4.4. So many folks in the Fed are actually, seemingly based on what's going on here with the SEP, it's not just Powell, but speaking on behalf of the Federal Reserve Committee, the FOMC, Open Market Committee, many participants are in that same boat of like, okay, inflation, if it's going to come and show up, we want to be prepared for that. Let's not even change rates at all. This up here, just as an FYI, would indicate, okay, 0 rate cuts for you, Mr. Market, into the end of the year. This is still giving us sort of like between that 1 and 2 rate cuts for the end of the year. The other things that are noteworthy in the S&P as we scroll down, let's blast down to the risks to the labor market right here. So risks to the unemployment rate. We'll zoom in on that. You'll notice, and what I want you to key in on here is a decrease and an increase, right? So about equal in margin, right? Now compare that to what we have out of PCE. PCE inflation, decrease and an increase. It's about the same. So ultimately, what I was personally looking for from the Fed to be like a subtle hint about whether or not the cuts were going to happen or not was if they increased, or you could frame it two ways, right? This either decreases at a smaller margin than what we have happening over here, or it actually increases. So let's just say that the risks to the, let's just quickly draw this in for the sake of illustration. If this is the risks to the labor market, right, and maybe it looks something like this, right? That's kind of the change. It's almost a mirror image of this chart. What would have been more of a tell that the Fed is more dovish is if the risks to the inflation side of the mandate were broadly balanced and less weighted to the upside as such. If this is actually what we saw out of this SEP document, and they were basically telling us and telegraphing, hey, we're pretty concerned about the labor situation right now, that would indicate that they're more willing to cut rates. That's not what we got. It's really not what we got. These moved in almost equal proportion where risks to both sides of the mandate still looked elevated, but slightly lower than what we had in the previous SEP. So really nothing helpful, even in the document itself here from the Fed. What other callouts? Jerome Powell was continuously reinforcing, again, that inflation is being forecast around the 3%. He thinks that the labor market is fine as of right now. However, he acknowledges that, just sort of recalling from memory, if you have a job, you're sort of okay. Layoffs are not spiraling out of control. But if you don't have a job, it's much harder to find a job in this environment. So I would just be very mindful of that situation because all it takes is a very subtle uptick in layoffs. And if the environment is already telling us that it's very difficult to find jobs, you're going to see an explosion in the unemployment rate. Now, of course, I don't want to forecast that, and it's not why we're here, but I think the Fed has to be careful with making the assumption that everything will be fine in the labor market. And honestly, who am I to say? But my personal view is that inflation probably isn't as big of a deal as Powell makes it seem in the press conference, and perhaps he's just using that as a hardball to keep rates kind of where they are currently. Anyhow, let's move along. What's going on with the earnings calendar? Absolutely nothing, so we're moving back on over to the charts here, and we're keeping this quick for today's session. Bonds relative to themselves with a pretty indecisive Fed, and just like, hey, let's wait and see. Let's wait for August. Let's wait for September. No movement out of this. The longer end of the curve still remains elevated over the upward sloping 50 SMA. So broad market, or not even the broad market, but the bond market is doing what it should be doing, pricing in some sort of handicap for inflation, basically. But the short end is saying, we don't know what to do. There's nothing to do here until Powell gives us some better clarity. So with that, let's move along to credit spreads. No issues here. Still flat, depressed towards these lows. Not really indicating much of an issue out of that. Junk bonds, completely flat, nothing to talk about here. LQD real quick as a check. Slightly lower high, but still elevated off of these lows, whereas obviously the S&P is sitting on the lows. Small, minor divergence that would maybe keep me open-minded to continued consolidation here in the equities market down below. Let's quickly look at breadth. Subtle uptick. Let's go to a daily chart here, please. There we go. Subtle uptick out of new highs versus lows, but your moving average chart still moving slightly lower. As we're stuck sideways in balance, I wouldn't read into this as like oh my God, the breadth is so bad, the market's got to crash. No, it's the market's balanced. There's really no red flag with breadth. We're looking for a major data outlier if we're going to make some conclusion about which way the balance might break. Let's go to the RSP. In balance, nothing to talk about there. Let's quickly look at the QQQE. Mild little breakdown if we just zoom in on that a little bit. Mild little break back below these range highs, maybe worth carrying forward. I think it aligns with the narrative we've set forth so far that buyers are just exhausted, and it wouldn't be a shock to see a little bit of a downside pullback here into those next key levels. Let's check in on volatility. Again, no major data outlier. As we're in balance, as we have conflict in the Middle East, as we just sort of got past the Fed, not shocked to just see volatility here. If we quickly throw up the VVIX, same concept, not a shocker. With the Fed in the rearview mirror, not a surprise to see this moving lower, some unwinding of some hedges. Let's take a look at the one-day VIX, and that is down here at the very bottom. I wouldn't be surprised to see this open lower, of course, unless there's a major headline over the closure tomorrow and opening up for Friday. Maybe there's a U.S. strike, maybe there's intervention, who knows? But that's sort of the only situation where I would think the one-day VIX pops higher. Otherwise, we're probably going back down towards the midpoint of the range in here. We have updated our volatility spread up at the top. So the only thing to call out is that the furthest out that we're watching is in a small backwardation right now. It's just a subtle watch. We just had VIX expiration in terms of the futures, VIX expiration, if you will. Let's go here to the VIX. And you can see that all that's doing is pricing in this subtle backwardation right there. The curve overwhelmingly, though, is still in contango, which is comfortable for money managers to allocate capital. Let's get back on over the charts here, and let's take a look through our core list of companies and see what's going on. So, as mentioned in the intro, balance doesn't last forever, but we're certainly in some balance right now. NVIDIA, this is a really ugly view of the NVIDIA daily chart. Let me fix that up a little bit. There we go. So there's your balance. We did start to break a little bit into the close over that 145 mark. If we go to the hourly time scale, you can see this very cleanly. The big watch here is, okay, first step, check. All set, decent daily close over 145. Next step, consolidation persists here. Show me the Brigade bolt over 146 because on the daily, we know there's room into 149.25. So NVIDIA will be a top watch into the Friday session as it's starting to break over the balance range highs here as of today's close. Let's see if it can get follow through over the 146. We know that semiconductors as of right now have been hot. Let's take a look at Microsoft, another great example of a multi-day balance range. Let's zoom in further. Here you go. How many days of balance now? 5. So blue sky breakout is definitely in store over the 479.75. We'll see if we can get that. Keep in mind that this NVIDIA chart, this Microsoft chart, it's kind of counter to the idea that the broad market buyers are sort of tired right now or exhausted. So just have that in your back pocket in terms of the best outcome here. If we're thinking about an ideal situation where, okay, let's fully size the position at like max size, we're going in with confidence. Of course, we would just want to see a balance range breakout with a broad market that's either launching off of a higher low or also breaking local highs. So that's one consideration here. It doesn't mean don't take these trade setups in Microsoft, in NVIDIA, but just be aware of the market context when and if these breaks are taking place and understand that you should manage the expectation of the trade as well as the trade position size if you're going counter to a falling market and Microsoft is trying to break out. Let's move along to Apple. There's really not much to talk about here until this range resolves. I would say a saving grace for the market might be if Apple is going to remain a balanced trade, right? And again, we'll go through the same illustration as what we did on the, the XLY chart. Simple balance trading says that we should be thinking about buying opportunities towards the bottom end of a range, and we should be thinking about selling opportunities towards the top end of a range. Well, where is Apple? Obviously, it's towards the bottom end of the range. So your risk reward actually favors something along these lines. Now, Apple has just totally been a slug. I think that the more we think about Apple, the more it drives me mad. And I think, this is sort of a thing of the past. It's an old giant that's sort of going to fizzle out a little bit. I think it's going to be replaced by new market leaders. Palantir is already on the core list for a reason. So I have some thoughts about Apple in the longer term sense. But ultimately, as a trader, maybe there's something to do here around the 193.75. Let's move along to Amazon, another culprit of key levels. Actually, wow. We knew that this was breaking the 214 into the close, but not nearly as firmly as it actually closed on the low there. Amazon will be a watch if the broad market is pulling back and we don't want to take longs in NVIDIA or Microsoft. Amazon on any rallies that now fail 214.50 are a great short in my opinion because you start to get the indication of a daily double top. The buyers failed to accept in this consolidation and launch prices higher, and now you have trapped overhead supply. So rally rejections 214.50, ultimately looking for the proboscis of the mosquito pattern here, and then ultimately here at 206.50 for the daily retest of the breakout of this sort of semi-rounded bottom after the China gap, right? Daily 200 may offer some super support depending on timing into early next week. The daily bar certainly looks heavy, looking over these two prior highs and closing extremely weak underneath this previous pivot. Let's move along to Google. Another name that will be a short watch if we need it. The idea here being, okay, rally rejections of 174.75, target the equal low. Once again, you could call that proboscis from the mosquito pattern, and then thin structure retracement here into the 168.50 origin. I would prefer to take the Google short, noting that this daily lower high is more substantial, right? You could still get the idea of a double top, something along these lines, But this lower high, right, is already a bit more, it gives you that bearish taste even earlier than what we have on Amazon ultimately. So both of those are interesting to the downside. Something back on the upswing would be Meta. The daily candle does not look great, but undoubtedly it's still in a 3-day balance range here. If we Brigade Bolt up and out of the 705.50, great, fantastic. Really would like to trade Meta along these lines in the upward direction. It's to be determined ultimately, but this in here, we'll wait and see. Right? So I would prefer not to trade Meta short, if I'm being honest, into the bottom of this flag. I would prefer to look to Google or Amazon if we're going to go short there. Let's take a look at Tesla. Let's start on the daily chart, actually. Tesla's in a multi-day range also, so you have a 7-day balance range, a calendar week balance range. It would be great if Tesla could just show us the clarity here or here. So once again, it's not exciting news to bring you today. It's not like the action's happening right here, right now. But these are the times where you can't forget about the setup. You can't just say, oh, let's forget about Tesla. Screw it. It doesn't matter. It doesn't mean anything. It's just stuck in a range. Because that's when you're going to miss the trade that does this and then runs for 5%. And the day after it runs 5%, you're going to be trying to buy it at the tippity top when in reality, the best trade entry is here, right? On the Brigade Bolt over 334 or underneath something like 31375, right? So that's Tesla. It literally closed in the midpoint of the range. Not much to do on it immediately, but we'll be waiting patiently for this, and we'll be waiting patiently for this. Let's move along to JP Morgan. Great day out of the banks. They will actually come into play as a trade idea on one of them in particular. Clearance of this 270 through the thin structure, perfectly hitting the target at 277.50. If it holds over 270s, all-time highs, I would have to imagine, right? Brigade Bolt breaking out of this triangle, weekly bull pennant. The measured move on that is massive. It's new blue sky breakout. So JP Morgan financials look good. The reason the XLF chart itself did not look good is really due to MasterCard and Visa. Let's take a look at Netflix on the daily chart here. And I know we didn't look at the hourly chart on Tesla, so let's, excuse me, just go back to that for a second. I don't think there's anything new to learn, right? You just have your balance. So this is why I skipped it, but just to sort of show you the hourly chart, there you go. Let's go back to where were we? Netflix, swing traders still are watching this probably on the hold over 1210. Day traders not interested in this range. Netflix needs to be trending cleanly if you're even going to touch it at all from a day trading perspective. Otherwise, too spready, too thin on the contracts. Just I would stay away. Palantir looks good for a possible. I would be watching this double bottom like that. Theoretically, if 140 fails, you could maybe build the argument for bear flag. So strike a trend line through that trend line, maybe rotates to this previous set of highs. But my first thought, given relative strength on Palantir, is do we get the double bottom neckline breakout? So we're not blindly long under 140, but if we Brigade Bolt over 140, I do want to be involved up to about 143.25 and then seek blue sky breakouts beyond that. That's Palantir. Broadcom here is up next. It's one of the more tired semiconductors, if that even makes sense to say. It's not really testing this high. If you could compare Broadcom to maybe like AMD, which is on a pullback, very interesting around the daily 200. Actually, was this one of the trade ideas? No, it wasn't. So here's an additional one outside of the 4. But AMD at the daily 200 at this 124.50, I think you could easily pull back and get there. You have the makings of the head and shoulder. So break through to get there, and then look at the daily chart on that. As you zoom in, it's a retest of this previous high and the daily 200. So very interested in whether or not AMD can hold that and rotate back higher. I know it used to be the advanced money destroyer, but AMD may have turned a new leaf here. So that is the core list of companies. Let's get into the original 4 ideas I have for you. Snowflake is up first on the chopping block, and the idea here is that you've got daily high and tight consolidation in a balance range like many other things, but overhead we have gap to close. So over 213.50, 226.25 is the idea. You can look left on this. I think I have to grab more time. Here is your previous monster gap. So big gap down on earnings that still remains unfilled. That's where the 226.25 is coming from, and that is our upside target should we break out of this as a little bit of a bull flag. So 213.50, 226.25. That's Snowflake. Next up, CoreWeave, CRWV, ticker on that. New all-time high break today. Didn't really sustain. However, look at the lower wick holding up over the top end of the flag range from back here. I love the hold of this 162.15, 166.50. Consolidation Brigade Bolts to blue skies. Looks great. Looking for follow through. And if it's going to go on like one of these rampages, if it's going to squeeze again or just go on this parabolic continuation play, could be lucrative to throw some contracts at it. I have honestly yet to trade CoreWeave options. I'm watching them closely. They tend to get a little bit spready when the not the volatility, but rather when the when the session gets to like 10 o'clock, off of the opening drive, right? 10 o'clock, 10:30, the volume starts to dry up on those options contracts unless it's really moving. So still a little hesitant on that. And if you've got experience trading the CRWV options, let us know down below in the comments section. But I'll be watching it closely as a setup nonetheless. Let's move along to MS, which is, of course, Morgan Stanley. It's very similar in the sense to JP Morgan that the consolidation just hasn't broken yet. So here we have a thin volume pocket that we could retrace. And the idea would be, if you're interested in trading banks, Morgan Stanley over 133.15 targets 135.75. All right, so that's MS. Next up, we have HOOD, Robinhood, which of course should be on a lot of folks' radars. Brigade bolts here over the 77, over the 76.50. Looks really good breaking out of this as a daily balance range. So retest higher low Brigade bolt longs off of this zone for risk and reward. Really up towards that 85 handle is the next play, right? This kind of like that is the risk reward on it. One more trade idea. It's actually just a chart I want to check in on, and we may as well just do it together. CrowdStrike, how do we fare on this? I know that it was in a balance, so let's just double check it. No break, but over 490, right? Over 490 starts to get interesting there on a Brigade bolt. So there's an additional, what does that bring it to? 6 if you want to count AMD as well. So anyhow, that's what I've got for you in today's very, I think it was quick. I'm going to have to look back at the timestamps here in just a moment, but shortened, expedited session for the midweek as we come into a holiday session for Thursday. So again, remember, markets will be closed tomorrow. Don't show up to the desk expecting to pull off any big trades. You'll be met with a big fat order will not go through. And we may or may not do a Q&A, sort of hangout, coffee and charts in the morning. It depends on who's around up in the office, but just turn the bell notifications on, subscribe to the channel, hit the thumbs up button, all that stuff YouTubers are supposed to say. You'll get a ding if we do end up going live, and you will be alerted. So with that, have yourself an awesome day off from actively trading. Don't get too hung up at the computers. Enjoy the time away from screens. When and if these balances break, we'll be ready to pounce on the opportunity. We'll be live at the least for the Friday morning session anyways, up here for the pre-market prep, kicking off at 8 o'clock Eastern time, as we do every single day. So with that, if you enjoyed the video, if you learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Have a green rest of your trading week, and as always, I will see you in the next one.